We have a new filing to talk about out of SIBO, and actually this one is out of quite a few exchanges, so let's go ahead and just take a look at that real quick. And it's mainly out of the SIBO, so we have the NYSE American LLC with this same rule filing. I'm sorry, this one's actually different. We'll go over this one later. Basically, we have the same filing out of all the SIBOs. We have SIBO C2, SIBO Exchange, we have SboeBZX, SboeBZX, all filing the same filing, which is the one we're going to be talking about, which is SR-CboeBZX-2022-009, drill through price protection. Let's go and take a look. So basically, this was filed on February 28th. Notice filing immediate effectiveness of proposed rule change relating to modify how drill through price protection applies to users' orders when multiple stop order and stop limit orders are triggered by the same price. The purpose of this rule filing is to amend current Rule 21.17, which is additional price protection, mechanisms, and risk controls, to add new Rule 21.17D3, which modifies what the drill-through price will be for stop orders and stop limit orders when multiple stop orders and stop limit orders are triggered by the same stop price specified by users. Now, a stop order is an order that becomes a BZX market order when the stop price is elected. A stop order to buy is elected when the consolidated last sale in the security occurs at or above the specified stop price. A stop order to sell becomes a limit order when the consolidated last sale in the security occurs at or below the specified stop price. A stop limit order is an order that becomes a limit order when the stop price is elected. A stop limit order to buy is elected when the consolidated last sale in the security occurs at or above the specified stop price. A stop limit order to sell becomes a sell limit order when the consolidated last sale in the security occurs at or below the specified stop price. Drill through price protection is currently described in Exchange Rule 21.17D, and 21.17D provides that if a buy or sell order enters the BZX options book at the conclusion of the opening auction process, or would execute or post to the BZX book at the time of order entry, the system executes the orders up to a buffer amount, which the exchange determines the buffer amount on a class and premium basis, above or below the offer or the bid limit of the opening caller or the NBO, which is the national best bid or offer that existed at the time of the order entry, respective the drill through price. Now, currently, the way the rule is in place now, when multiple stop orders or stop limit orders are triggered by the same price, the system considers them separate orders received in sequence and enters them sequentially into the BZX book. As such, when determining the drill through price for each order, the system uses the contra side, which is the opposite side, national best bid and offer, that existed at the time each of the orders was entered into the BZX book. By applying drill through price protection in this manner, the exchange has observed, particularly in thinly traded markets, that the first order triggered will trade with the best priced contra side order, while the second triggered order can trade at prices that may be multiple price levels away, and it is using the NBBO that existed after the first triggered order executed. So if you've ever been in there trying to hit the bid on one of these stocks with a wide spread, and when you put the bid order in, it fills the first one, and the second one, you can't get anywhere near that first fill, that's what this is talking about. That's what they're going to be working on fixing with this proposed rule change. Accordingly, the exchange seeks to enhance the drill through price functionality as it relates to stop orders and stop limit orders through the addition of this proposed rule. Under proposed rule 21.17D3, rather than using the separate drill through prices for each individual stop order and stop limit order, the system will instead use the contra side national best bid and offer that existed at the time the first order in sequence was entered into the book as the drill through price for all orders. This is the drill through price that would apply to each stop order or stop limit order if it was the only one triggered at that price. Now, system means the electronic communications and trading facility designated by the board through which securities orders of users are consolidated for ranking, execution, and when applicable, routing away. BZX book means the system's electronic file of orders. So the current functionality of this rule. Assume the drill through priced buffer for a certain option series is 25 cents and that the following quotes are in the BZX book. Quote 1, which is at the national best bid and offer, for 5 times 7. Quote 2, for 4 times 8. Each quote has a size of 1. Additionally, the following stop orders / stop limit orders are being held in the system when the quote 1 offer is updated to 650. They were received by the system in sequence. Order 1, sell 1 at market, stop price equals 650. Sell 1 at market, stop price equals 655 for order 2. And then for order 3, sell 1 at market, stop price equals 650. Per current rule, the following will occur in today's environment. Orders 1, 2, and 3 are held in the system and handled as separate orders received in sequence. Each have stop prices less than the NBO and are therefore triggered by the 650 quote, and enter the BZX book for execution or posting. Under today's functionality, the system assigns each order a separate drill-through price equal to the contrasite NBBO in existence at the time each order separately entered the BZX book. Order 1 will execute against quote 1 at $5 using the NBB of $5 as the drill-through price. The system would prevent execution beyond $4.75. When order 1 executes against quote 1 at $5, that NBB will no longer be in the BZX book. Instead, order 2 will execute against quote 2 at $4 and will use the NBB of $4 as the drill-through price and prevent execution beyond $3.75. Order 3 will cancel due to no liquidity left at the drill-through price of $3.75. So that's how it currently works. Now how it's going to work. Again, assume that the drill-through price buffer for a certain option series is 25 cents, and the following quotes are in the BZX book. Quote 1, 5 times 7. Quote 2, 4 times 8. Each quote has a size of 1. Additionally, the following stop orders / stop limit orders are being held in the system when the quote 1 offered is updated to 650. They were received in sequence. Again, assume the drill-through price buffer. Oh, that's the same paragraph. Whoops. Let's go back to the filing. Sorry about that. So, per proposed rule 5.34a4e, the following will occur. Orders 1, 2, and 3 each have stop prices less than the NBO and will therefore be triggered by the 650 quote and enter the book for execution or posting. A drill-through price for all 3 orders is set at the contrasite NBB of $5. Order 1 will execute against quote 1 at $5. Orders 2 and 3 will cancel due to no liquidity left at the drill-through price of $4.75. So that's the difference. Before, they did not include all 3 at the same time. It was all separated. Now it's all included in one, and now orders 2 and 3 will be canceled due to no liquidity left at the drill-through price of $4.75, rather than the drill-through price being $3.75, which is a much, much better situation for the industry and not the people gaming this on the other side. So anyways, that's basically it. Let's get the in essence part going. In essence, the exchange notes that aside from the difference in the drill-through price, the drill-through mechanism will apply in the same manner to these orders. The exchange is not proposing wholly new drill-through protection behavior, but rather only seeks to modify the reference price utilized by the drill-through price protection for stop orders and stop limit orders if multiple such orders are triggered and entered into the BZX book for execution due to the same price event. By using the same drill-through price for all triggered orders, the proposed modification will help the drill-through protection prevent executions that are too far away from the NBBO when multiple stop orders and stop limit orders become eligible for execution. Basically, it's going to, may hurt a little bit trying to game the bid-ask spread on these wide plays, but we'll have to wait and see. Could get better, but we'll have to wait and see. That's generally the idea. They're consolidating those orders. They're going to sweep them all at once instead of doing individual drill-through pricing.